Hey everyone, me Kevin here. So I'm about to leave DC and I want to give you a breakdown of what the heck just happened with some of these numbers, because we got a hint from Nicki Leaks over at the Wall Street Journal. We got a little bit of data and a recession revised away. This is crazy. So let's go through some of this data. I'm unfortunately still on the iPhone 15, so hopefully we're able to reduce some of the sound here, but let's get this done before I take off so I can upload it and go. But first of all, GDI, that's gross domestic income, was suggesting that in 22 and 23, maybe we should have been in a recession because gross domestic income was so low, but compared to GDP, because GDP was still doing well. Well, that gap was just revised away by the Bureau of Economic Analysis, along with the decline in the personal savings rate, which was as low as 2.9% just in July. And all of a sudden, it's revised up to 4.9%. Now, it's still above the 5% level, it's still below the 4% level. I can't even speak correctly right now. It's still below the 5% level that people like to look at as like, all right, now we're starting to get into this like really low personal savings environment, which isn't good, because usually when you see personal savings come down so much, it's a lead into a recession because people spend the rest of the money they have, and it implies that they've already gone through their household savings buffers. Now, this is actually good news that it's revised up if we believe the numbers. Now, I'm slightly jaded. I'm not heavily jaded, so I actually lean towards saying this is good news, that hopefully there's some truth to this data. It should help us with our GDP estimate for the Atlanta Fed GDP numbers, which will get revised today, maybe, but it all depends on how much the PCE numbers weigh in this morning. Now, PCE, Personal Consumption Expenditures Inflation Gauge, preferred measure, this basically came in at expectations, and there's something really important here. Even though personal income missed by 20 basis points and personal spending missed by 10 basis points, which isn't good, there's actually a bigger warning. Is that plane gonna start up now too? Oh, it's gonna get way too noisy over here. Okay, there was a bigger warning. The bigger warning was that you were in a position. Oh, this is actually better anyway. I didn't know the AC was on. The AC's on, this is great. The bigger warning that came was that you actually had Nicki post a story this morning saying that I personally think Jerome Powell may have had some, little nudge, winks involved in. And he says, the question now is how much weakness is under the hood. Bank lending has slowed to a crawl over the past year, something usually not seen outside of recessions. And even though the top line interest rates will come down, it'll take a while for people to actually get a benefit from higher or lower interest rates, because the average mortgage today is 3.9%. A lot of corporations and household balance sheets have lower interest rates. So even if you drop interest rates 1 or 2% now, you still have cheaper debt in the bank or in your household than what you could be getting in the market today. And that means that stimulative effect that you're hoping to get from the Fed's cuts may come way later than expected, which is not good. Here's just an example. Oh yeah, this guy's starting up big. Oh man. Here's just another way to think about this. So last year, inflation, PCE, sat at about 3.4%. Man, all right, it's getting so noisy, boys and girls. That guy's starting up. I don't know if you could see him. You see the lights over there? It's kind of cool. But anyway, all the curtains are in the way over here. I'm trying to move through with my laptop. I'm going to hit the parking brake. I'm going to screw stuff up over here. There we go. So what's wild here is that the 2.9%, we were talking about the inflation number. So a year ago, we were sitting at PCE inflation of about 3.4%. Well, today, the 3-month annualized PCE inflation report is sitting at 1.9%. Nicki talked about this morning, this morning. And what's remarkable about that is that means that we've actually tightened by keeping interest rates stable by 190 basis points. Now we're going to minus 50 basis points off of that because we just cut by 50 basis points. But in plain English, the Fed just crimped down on the economy more by 140 basis points, 1.4% of basically effective interest rate hikes over the last year. And so now the question is, hurry up, Fed. Can you cut quickly enough to prevent the R word? Nobody knows. The problem with recessions, we talked about this yesterday, is they come suddenly, right? It's no recession, no recession, no recession, no recession. Oh my gosh, we're in a recession. And so it's really hard. What drives me nuts though right now is that stocks are pricing in an 88% chance of a soft landing. Listen to some of these PEG ratios, and I've got them written out over here. They're just absolutely crazy. You've got Costco at a 4.4 PEG ratio right now with a 50 PE. That's insane. And the way I do this is I take the end of the year EPS, divide that into the price to get PE, obviously, and then I go divide in the forward 4 years of average growth. So Costco is at a 4.4 PEG, price to earnings growth. That's very high. They should be at like under a 2. Palantir's at a 4.65. They should be at like 2.5. So they're at least 2 PEG too high, which is very bad. They're almost twice as high as they should be. Tesla's at a 3.38. They should be at like a 1.67. That's way too high. Enphase is low. Nvidia's decently low as long as their growth holds up. Ubiquity's doing okay. Wingstop's at a 5.17. That's insane. Microsoft's at a 2 PEG, a 2.17. That's actually pretty good for Microsoft because their margins are so high. A 3 PEG on Walmart is rich. And I know Supermicro is only at a 1.74 PEG, but I don't trust that company, not because of the accounting issues, but because their margins are so low. And then they kind of deceive us on how they're giving away AI server racks. I think it's a kooky dookie. So anyway, this is interesting. These are all things that sort of evidence that there's a gradual slowing going on out there, and it's not good. Now, of course, the University of Michigan sentiment, the final read today, came in a little bit better than expected, which is good compared to the preliminary 2 weeks ago, as sentiment is improving a little bit, which is fantastic. You know, potentially the best that we've had in the last 4 or 5 months, which is great. And it suggests that maybe there's some hope now after the 50 basis point cut that maybe we can actually start going in an upward trajectory. We'll see. And that's the tough part here, is where do we go from here? My positioning is that we'll have a lot more information by the election, and then we evaluate. Do we think that the Q4 sales are going to lead to layoffs in Q1, or did we dodge the recession? The next few months are the tell, in my opinion. By the way, if you want actual personalized financial advice, make sure to go to stockhack.com. We're now taking on clients starting October 1st. So we're super excited to see you there. Go to stockhack.com to learn more about how we can actually help you, give you real financial insight. This is not about, you could be all in S&P 500. This is all about evaluating. How do you balance that with real estate, with crypto, with bonds? How do you balance that with, do you have a trust, a will? How are you setting up your retirement? How are you setting up your children's future? How are you setting up your financing, your debt, your jobs, your business? All of that. Learn more at stockhack.com. We'll see you soon.